Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. It is Monday, June 23rd. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money. We're getting you up to speed with just 1 hour before the closing bell rings on Wall Street. Breaking news, stocks just off the highs of the day. That's after Iran's retaliation appeared to be more restrained than anticipated. Iran launched multiple missiles against U.S. bases in Qatar, but Qatar's defense ministry says it intercepted them. In the wake of the violence, stocks rose. Oil prices slipped Monday after Iran attacked the U.S. military base in Qatar. That attack was in retaliation for U.S. military action on its nuclear facilities over the weekend. There is no word of supply disruption yet. Investors, though, we know, are watching the Strait of Hormuz oil supply route. We're going to explain why this area is so critical. And as the world focuses on Iran, Trump's one big beautiful bill is getting more expensive. There may be significant changes on the horizon for that legislation. With an increased eye on foreign affairs, we're going to explore what this means for investors and taxpayers. We've got 1 hour to go until the market close. Yahoo Finance's Julie Hyman and Nez Ferre with me, as well as Thomas Hayes. He's chairman and managing member of Great Hill Capital, all here with me to break down some of the moves we're seeing in today's action. Julie, we're going to start with you live from the floor of the New York Stock Exchange with an update on the markets.
Yeah, and as you mentioned, we're seeing stocks just off the highs of the session, and we keep seeing sort of unpredictable twists and turns in the conflict there in Iran, but then the market reaction also a little bit unpredictable, as we have seen. Now, as you mentioned, we had Iran then retaliating at U.S. assets in Qatar, but there are some market participants who have said it is not perhaps as severe, as widespread as had been anticipated. So that is what they're attributing the increase that we're seeing in stocks today to that. Everything, as we know, since this began, since Israel's strikes against Iran began, everything really flows from oil prices, right? We see the reaction in stocks sort of take their cue from oil because oil is the most directly affected asset by what's going on there. And then we're seeing stocks sort of react to that as well. Is this going to have an effect on prices? Is it going to have an effect on inflation, et cetera, down the line? So oil, too, we are seeing a big, deep drop in oil prices today. We haven't seen a drop like this at least since the retaliatory tariffs, the sort of worst case tariffs were announced in early April. So seeing a decline like that once again today as we see a worst case scenario for oil prices going higher, at least for now, sort of being taken off of the table or given a lower likelihood on the part of investors. And then I know in terms of other assets that we're watching as well, Bitcoin taking off to the upside again. We had been seeing it not really react like so-called digital gold, right? And initially, when we had some of this conflict heating up, we saw Bitcoin pull back. Now it is higher again. And gold prices, too, haven't necessarily been acting as you might expect, perhaps because they've rallied already so much this year. We initially were seeing a little bit of softness in gold prices, people not looking to that as a source of safety or hedging in this environment, Josh. So it's been interesting to watch the various moves that weren't necessarily as you might have predicted.
All right, so that's the stock market. Inez, what are the latest moves we're seeing with oil?
Yeah, Josh, and we are seeing that WTI and Brent crude are down 7%, more than 7%, with Brent around $71 per barrel and WTI around $68 per barrel. The market appears to be relieved that the world oil supply remains intact. Iran's retaliatory move that aim at U.S. base in Qatar was seen as a restrained measure. So up until this point, the oil market was really weighing the different scenarios with the outlook dependent on Iran's response. JP Morgan analyst said this morning that there was really limited regional appetite for a broader response. The key was whether Iran would close the Strait of Hormuz. That's the worst case scenario. That's where you would see forecasts for triple-digit prices. But even with the risk of supply, look, analysts are saying that time and again, there is enough oil. Remember that OPEC Plus has been increasing output in recent months. So much of Wall Street right now anticipates that Brent will be in the mid-60s range for the remainder of 2025 and $60 per barrel next year. That's assuming that the Middle East conflict risk premium momentum dissipates by then.
All right, let's bring in here Thomas Hayes as well. He's chairman and managing member of Great Hill Capital here with us as well. Thomas, I want to bring you in here. I bet you, Tom, there are some viewers who are watching this and they're saying, hold on a second. So the U.S. strikes Iranian nuclear facilities over the weekend. President Trump is dropping 30,000-pound bombs.
Yeah.
Right? Then today, Iran fires missiles at a U.S. base in Qatar. And I'm looking at the popular averages, and you see green across the screen. That might be surprising to some people. Does it surprise you, Tom?
This is a case of sell the rumor, buy the news, okay? If the great Art Cashin used to say, you sell the risk of war, you buy the first attack. What you have here, though, and what we heard this afternoon from sources was that this was a call-in retaliation attack to save face. And once we knew the magnitude of the retaliation...
Meaning by that, do you mean that Iran was giving Qatar advance notice?
That's correct.
Yeah, right.
That's correct. It was advance notice. It was symbolic so they can go back to their people. We don't take anything, and then come to the table. So it's either going to be a negotiation or a regime change. We don't know yet. But what we do know is this is very, very constructive for the region. This has been a long time coming. They were completely decimated. It was completely by surprise over the weekend. There was no ambiguity about the message. You will not have nuclear weapons, and it would take them so long and so much money to rebuild. So the market loves this, and the Saudis are going to continue to pump. The Russians are going to continue to pump to avoid sanctions. So oil prices stay low. That's the key thing for President Trump. That keeps inflation lowered, so we can get some of these tax cuts done, and we can deal with the big beautiful bill.
So Julie, I want to bring you back in as well, because what Tom is pointing out here, that is the interpretation today, that the market's thinking, you know what, the U.S. hit Iran and nuclear facilities over the weekend. Now Iran does hit back against the U.S. base in Qatar, but it's kind of limited. It's contained. The New York Times is actually reporting Iran gave Qatar advance notice of the attack as a way to minimize casualties, they say, citing sources. So the market thinks, here's the interpretation, hey, this is actually de-escalation. This is giving everybody an exit ramp, and that helps explain why the major averages are in the green. What do you make of that?
Yeah, I mean, I would say also the thing that I would add is even if we had seen that retaliation, again, it all flows from oil, and we've certainly seen geopolitical conflicts before that have been severe that do not have a sustained effect on the market. Look at Russia's invasion of Ukraine, which initially did have an effect on oil prices, had an effect on natural gas. That abated over time. It also had an effect on stocks initially that abated over time. So it really depends, right? There's not one playbook for geopolitics and for conflict, but we do tend to see that stocks, at least equities, don't necessarily see a longer term hit from these kinds of activities. The other thing I would point out is that things could still change, right? We don't want people to think, okay, the coast is clear and that's it, because now there is still the specter, the possibility that Iran could limit oil flows through the Strait of Hormuz. Now, the oil analysts we've talked to, Josh, have said that they don't necessarily think that's likely. It's not necessarily the base case, but if they do that, it could see, then we could see another effect on oil prices to the upside. I mean, Goldman Sachs was out with a note this morning saying the upside potential would be $110 a barrel. Again, it's not necessarily their base case, but it's not something that investors should entirely take off the table here. We are still in a potentially volatile situation.
Inez, I want to come back to you here. I'm looking at WTI, Inez. We're down more than 7% right now. We're back to 68.6. What do you chalk that up to, Inez? You study these markets so closely. Is it that the markets are saying, yes, actually what we're seeing here in the Middle East, the market thinks is the beginning of de-escalation? Is it President Trump's post this morning, Inez? You saw that on social media saying, hey, drill, baby, drill. I meant it. I want to see it. Let's make it happen. Is it all those things?
I mean, look, it could be all of those things. But as far as that post that President Trump put on social media, oil producers are not necessarily going to drill more because of that. They will drill what's better for their bottom line. I actually spoke to one analyst that said, look, you need to see WTI at sustained levels above $70 per barrel in order for shale producers to drill a new well. And we're seeing it at $68 per barrel. But so much of this has to do with really the oil supply and the fact that Wall Street believes that there is enough oil out there. You do have spare capacity. And I do want to point out one thing. You are seeing right now Brent at just above $71 per barrel. Take a look at this 1 month chart. This is around just before Israel struck Iran. So we are about $2 away from the closing price on the day before Israel did that first strike against Iran. Josh.
All right, thank you, Inez.
Thank you.
Well, while the world's attention is on Iran, President Trump's one big beautiful bill is getting more expensive. For more on the upcoming tax bill decision, let's welcome in here Yahoo Finance's Ben Werschel. Ben.
Yeah, hey Josh. So nothing can slow down the Republican push for tax cuts. It appears what we had over the last few days is a series of developments, clearly overshadowed by what was happening in Iran, on this big beautiful bill that changed the shape of it and taught us more about it. The first one actually came on Saturday evening, or about the same time as the attacks, which was a new report from the Joint Committee on Taxation that gave us a new price tag for this overall package. It's now expected, once you untangle some accounting maneuvers that the Senate is doing, that this bill is going to cost $4.2 trillion. It's going to add that to the debt over the next decade. That's a higher price tag than we've had before, and is already getting pushback from fiscal hawks who are already kind of wary of this bill and are now re-upping their criticisms of it. Whether they vote no in the end remains to be seen. The second is the what's called a bird bath. The Senate parliamentarian is going through the bill line by line to make sure it appeals to Senate rules. And she's striking a number of things out. We've already seen cuts to a provision that would have limited funding for the Consumer Financial Protection Bureau, cutting that out, changes to a lot of tax savings too, as well as the food stamp program. So those are significant changes, and we'll change the price tag further. The couple signposts for folks to watch in the couple of days. The Senate is pushing for this, to vote on this, to get this through the Senate by the end of the week. The first shoe to drop could happen this afternoon or tomorrow morning. That's the parliamentarian going over the Senate's Finance Committee's portion. These are the big ticket items. These are the tax portion. These are the Medicaid cuts. These are the clean energy credits. All of these things are going to be under review. So there could be a lot of headlines either tonight or tomorrow morning about whether those are changing or staying in the bill. And then, of course, we're heading towards a vote by the end of the week. John Thune is the Senate Majority Leader, and he talked about how when the senators are back today, and they're not leaving, in his words, until they pass this. And he suggested the first votes could start on Thursday and then stretch for as long after that as they needed. So a lot of focus, obviously, on Iran, but the Capitol Hill is clearly focused on getting this bill to the finish line for their ultimate goal of July 4th to the president's desk.
All right, Ben, thank you. Appreciate it. Tom, very quickly, I just want your take here. This big, beautiful bill, the tax bill. I'm just curious, as a money manager, as a guy who has to think through what to buy and what to sell, how do you think through that?
Yeah, I think, number one, what's underreported is what the bill unfunds. And if you look at what it unfunds, and a lot of climate stuff is taken out, which is why Elon Musk wasn't happy with the bill, it's more responsible than advertised. It's not perfect. The only way we're going to get out of 120% debt to GDP is through growth. And we need tax cuts. We need deregulation. That is happening. And things are constructive. I love the low bar that is set going into earnings season. They took down earnings from 9.3% earnings growth to 4.9.
Yep.
So there's a lot of global liquidity. You know, people wonder, like, why have international stocks outperformed? It's money goes where it's treated best. There are 15 cuts around the world last month alone, okay, which is the biggest amount since during COVID. And zero from the U.S. So I think what you're going to see is you start to see some division here. Waller. You had Goolsbee today. You had Bowman today, now coming out kind of against Powell. I think the Fed wants to be more dovish. I think global M2 money supply, you look, is at record highs after flatlining since 2022. So there's a lot to be constructive about here. A lot of growth coming, a lot of deregulatory policies. Animal spirits want to go. So we got through kind of the worst of the tariff. We got through the kind of the worst of the geopolitical here over the weekend. Now it's like companies are on track. Animal spirits are coming back.
Julie, bring me back here. I'm listening to Tom. He puts me in a good mood. What do you think?
Well, Tom is an optimist, in my experience. I'm curious about this tax bill, though. It feels like kind of a non-event at this point, unless, as you said, you're in, if you're in solar stocks, it does not feel like a non-event. But sort of overall to the market, it feels like less of a boost than it was. It's more if it didn't happen, that would be sort of catastrophe. It happening is kind of a shrug at this point, no?
Yeah.
A shrug, Tom. You agree with that? Is it a shrug for the market, the tax bill?
I think at this point, I think Julie's right. And as far as being optimistic, 70% of the time you're right. That's what happens with the stock market. Haven't met too many wealthy pessimists, so it's paid to look at the bright side of things. And you know what? Based on the data right now, there's a lot to be constructive about.
All right, let's bring in another market strategist for his thoughts here on what all this means for your portfolio. Let's welcome in Ed Yardeni, president of Yardeni Research. Ed, it is great to see you as always. You are a market strategist, Ed. You're an economist. I also know you're a student of geopolitics and geostrategy. Yeah. I know that, Ed, because I read your research every morning. So first of all, I'll get your take on what we're seeing in the Middle East. One interpretation here, Ed, is that the U.S. did hit Iranian nuclear facilities over the weekend, of course. Now today, Iran fires missiles at a U.S. base in Qatar. The market perhaps is thinking, you know what, that was a relatively contained, limited strike. And perhaps what this is actually is a sign of de-escalation. Everybody still has an exit ramp. Maybe that explains why there's green across my screen here. But what do you think, Ed?
Yeah, look, the leaders of Iran, the mullahs, the supreme leader, they may be fanatics, but they're not crazy. They've got to realize that they're basically on the short end of this whole development. They never expected to see Israel basically wipe out their proxies in Gaza, in Lebanon, in Syria. And so they've got no friends that have encircled Israel anymore. And it doesn't look like China, Russia, North Korea are kind of jumping in to help them out. So they are kind of all alone here without a defense system anymore, where the Israelis can continue to pound them and the Americans can come in willy-nilly and do the same with bigger ordnance. So I think that they are going to sue for peace. I don't know how exactly they do it, but I think they've retaliated. So check that box. And now I suspect there'll be some quiet discussions going on between the United States and Iran, either directly or indirectly, that will lead to a end to this war, and a recognition by Iran that they can't have nuclear weapons.
Ed, did what you saw this weekend and what you saw today, did it in any way, Ed, impact or affect your general market outlook?
Not at all. As a matter of fact, I kind of reconfirmed that I'm still looking for 6,500 by the end of the year. I still think that we're in sort of a roaring 2020s scenario. So by the end of the decade, I think we'll get to 10,000. I think we're in a bull market. The bull market started October of 2022, and I think it has a ways to go. I think it's going to have to be driven by earnings, because valuations are back to being rather high. But I do think that the outlook for earnings is actually pretty positive, because I still believe that productivity will continue to grow at a faster pace.
Anything, Tom, you're listening to Dr. Ed there. Anything you say you agree with, disagree with? What do you think?
I agree with Ed. We had dinner down in Miami. Ed, tell me, look, the forward multiples, 21 times. I'm optimistic. I know that this market's going to push to new highs this summer. Do you think the sell side consensus is too low on earnings, and that's why this can push higher, even though we've got a 21, 22 times forward?
I think there's the strategists, and then there's the analyst consensus, and the analysts are actually fairly optimistic, right? I mean, they're looking for $300 a share next year. Yeah. This year, last I saw, they were around $260 a share. Those are kind of exactly the kind of numbers we're anticipating. Yeah. And the problem with $300 a share is you put a 20 multiple on that at the end of this year, and you get 6,000. Right. You really have to, stretch the valuation multiples to get up even to 6,500. But I think we're going to do that. I think we'll do that with the Magnificent Seven. Maybe there'll be a few more stocks that are kind of viewed as those kind of unique companies that will have very high valuation multiples. And as you know, the Magnificent Seven still account for about 30% of the S&P 500. Take out the Magnificent Seven, and you got something maybe a little bit more realistic, 18, which is not exactly dirt cheap either, but at least it gives you some opportunity for upside on the PE. But I think it's going to have to be earnings.
Yeah. So your base case is multiple expansion into year end, and there's no accounting for animal spirits coming back now that some of the uncertainty is in the rearview mirror, and estimates going up into year end. That's not in your calculus at present, but you're open to it. Is that a fair characterization?
Well, I would say that I'm very optimistic on earnings, and I think the analysts were starting to cut back their expectations, and in recent weeks they've started to become more optimistic again, and they've been increasing. I look at forward earnings, which is analyst consensus expectations for this year and next year on a time-weighted average basis, and it's at an all-time record high. And I think it will head up to 300 by the end of the year. And I think there's still some room for the valuation multiple to get somewhat higher, maybe up to 22 or so. And 22 times 300 gets you pretty close to 6,500 by year end. And then I think next year we'll be looking at something like 7,000 on led by earnings again.
Yep.
Julie, I want to bring you in here as well. So Ed is constructive on the market. In part, I think, Julie, he's sounding some of the themes we've heard from other folks who are equally constructive. It comes down to the economy. Many thinking, you know what, this economy surprised them with its health and its resilience.
Yeah, I mean, I think it surprised many people with its health and resilience, but I don't know. I think, are tariffs gone? Are they just not going to have any effect? Are companies not going to pass on any of those costs to consumers? I mean, even if they do, yes, you could still have a scenario where you see the earnings outcome that is being described. But, that's not to say that there is an environment here where there is no risk whatsoever of potential weakness or, consumers continuing to be concerned.
Yeah.
How do you think about that, Ed? I mean, Julie's right to bring that up. President Trump, it does seem, has backed off sort of the maximalist position there, Ed, on tariffs, but I am curious how both as a strategist and an economist you think through that.
Well, I kind of agree that, tariffs haven't gone. It's still an issue. It's going to probably get resolved over the next few months. I think the market is looking past the tariffs and concluding that the economy will continue to grow. I think it really is all about the resilience of the economy. For the past 3 years, we've had probably the most widely anticipated recession of all times that didn't happen. And then over the past few months, we've had the similar kind of situation where suddenly people were convinced that a Trump tariff turmoil, as I call it, was going to cause a recession. And now that kind of concern has come down. And then we didn't really even get much of a panic reaction from what's been going on in the Middle East. If anything, it seems like the way things are going, the market's actually pretty satisfied that things will be all right, that it'll work out, and it might work out much better than anyone possibly anticipated. But resilience is really what's driving the market. It's a surprise resilience of the economy, and what that means is earnings have been better than expected by most investors anyways. And it also means that investors are increasingly willing to pay a higher multiple. If you thought there was going to be a recession like in 3 months, you certainly wouldn't want to pay these kind of valuation multiples. But if you become more and more convinced that this thing could last maybe through the end of the decade, then I think you're going to see that supports valuation multiples.
Ed, we are always lucky to have you on the show. Thank you for joining us, sir.
My pleasure.
And we are just getting started here on Market Domination. Coming up, Tesla stock popped as its robo-taxi event kicked off on Sunday. We're going to check in on the EV maker as well as some of our other top trending tickers later in the hour. And at 3:30, it's the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into 2 stocks to help you make the best moves to your portfolio. Stay tuned. Much more Market Domination. That's still to come. Now time for some of today's trending tickers. Julie Hyman and Thomas Hayes here with me to discuss. And some of the names we are watching are Tesla and Stellantis. We're going to start off here with Tesla, which is seeing big gains today after the unveiling of the company's robo-taxi service yesterday. The electric vehicle manufacturer launching the program with 20 cars that will still be occupied by employees to monitor, with each ride costing a flat fee of $4.20. CEO Elon Musk says that Tesla will likely expand the service based on its performance. Tom, what do you make of it?
Well, it's like a magician. Look over here. It's the illusion. I mean, the car business has deteriorated since his involvement in politics. However, if he's right, I just saw a quote from him. We expect hundreds of thousands of robo-taxis, if not millions, by the end of the year. That is a bold statement. If he gets anywhere close to it, maybe today's move is an underestimation. However, if we look at the car business, that's another story. And I think it's a trade-off. You're always betting when you pay the valuation that you do for Tesla, you're always betting on the man. And he's delivered for many, many years, and the followers want to continue to bet on him. So this is a step in the right direction. Robo-taxis could be game-changing, but it remains to be seen. If you have drivers in the car, it's not a robo-taxi.
Julie, bring you in here. I mean, as Tom says, you bet on the man, right? This is what Musk says. Musk has said this. If you own my stock, it's because you are a long-term believer in my vision for autonomy and robots, Julie.
Right. Of course. I've said this for a long time. Tesla is a faith-based stock, right? People are not buying it because of what is happening today or what happened yesterday. They're buying it because what they think is going to happen, what they believe is going to happen tomorrow and in the years to come. I mean, our friend Dan Ives over at Wedbush is a prime example of that. He was there. Him being a big Tesla booster, no surprise, he was there over the weekend, and he talked again about the $1 trillion autonomous possibility, the journey, as he calls it, that is not just to do with the robotaxis, but to do with the AI sort of thesis that he has around the stock overall. I thought it was interesting. Our friend Jordan Klein over at Mizuho is a desk analyst over there, and he said, you know, the people that they sent to do this test were people that they knew were Tesla supporters. And even given that, Bloomberg is reporting that some of those influencers, some of those Tesla folks did point out that the test didn't go without flaws, right? They pointed out that, you know, some of the cars went above the speed limit, which maybe isn't a big deal, but they pointed out maybe some turns that didn't make sense. There was one group of folks in a car reportedly that tried to push the button to ask it to stop. And I guess eventually it stopped in the middle of the road. So there are still some bugs that they're working out. It's not like that this thing is, you know, flawless and they're going to be rolling it out to a bigger area and to other cities right away. That said, a lot of analysts did say that this went a little bit better than expected, was at least neutral.
Yeah, not to mention the competition as well. You got Waymo, you got Amazon, Zoox, but to Tom's point, stocks tacking on about 8% in today's trade. All right, here's another one we've got to check out. Stellantis' new CEO, Antonio Filosa, stepping into his role today by avoiding any major changes to the senior management team. Analyst at Jefferies saying that revamping Stellantis may not be a full-time job for Filosa, who is also still maintaining his role as head of the North American market. Shares of that automaker have been dropping since the market opened. The stock price is overall down about 10% since announcing Filosa's appointment as CEO. This one is interesting, Tom. You did have, all right, so we reorganized management. The CEO is part of this 13-member senior leadership team at the company. You know, Bloomberg does know the new CEO here, he's got a lot on his plate. I mean, halting a sales slide in the U.S., they talk about an aging lineup, model delays, pricing blunders, but what do you make of it?
I think rule number one is they should probably get rid of the other 12 managers. Then they could be lean and more efficient. Look, that's a tough business. We are in the, we have a business that supplies the sealing systems around the windows, the fluid transfer systems. I'd rather be an arms dealer, because what's going to happen is Besant's going to be successful with bringing rates down modestly this summer. That's going to bring down financing rates for cars, but it's going to be a race to the bottom. There's going to be a huge amount of supply. Their margins are going to continue to go down, the OEMs. The suppliers of the parts are going to be the ones that do well, because we've got average car on the road is 13.5 years. There's a huge pent-up replacement cycle. We just need to see the incentives, and we need to see the financing rates come down, and they're going to start to do huge, huge volumes. The question is, what are the margins of the Stellantis, the Ford, and the GM going to be? I don't want to be in that business.
All right, Julie, bringing you back in here. I hope Tom is right that those rates are coming down, because I would be certainly interested in making a purchase, as you well know, my friend, if they did. But Stellantis, your thoughts?
I know. I mean, if you look at how Stellantis has done over the past 12 months, I'm just looking at the numbers here, they're down like 55%, the U.S. shares. And we know that the car business overall has been challenged as of late, right? But compare that with GM, little changed over the past year. Ford is down about 12%. So we see there, obviously, that Stellantis has been underperforming its peers. It's not just sort of struggling in what is a difficult car market, it's doing worse. And I don't know that we know yet from Filosa what those steps are going to be to turn it around.
We do not. But for now, we move on. Some news on the weight loss front. Amgen revealing plans for phase 3 of its highly anticipated GLP-1 Maritide. For more, we're bringing in here Yahoo Finance senior health reporter Anjali Kamlani. Anj.
That's right. So we got news from Amgen today, which is at the American Diabetes Association conference. That's why you're getting a flood of GLP-1 news today. And their latest is that they've started enrolling for their phase 3 of Maritide. Now, we remember this drug is their weight loss drug that is going to enter a market that is competing with Eli Lilly and Novo Nordisk. Currently, the drug has about 20% weight loss for those without diabetes and 17%. And as you already can tell with those numbers, that's a little bit lower than what the competition on the market is, Lilly being the lead with 24%. And so that's the market that's going to enter in. We do know that they have changed how they're doing the dosing for phase 3, looking at a step up or a 3-step up. And they did this in a phase 1 trial to kind of figure out, because they were having some issues with tolerability, not abnormal for these kinds of drugs, but of course, trying to figure out how to make it more appealing for patients, and this is why. So looking at that, they are going to start off at 21 milligrams and then move all the way up potentially to 350 milligrams. And that's sort of what we got from the company today, and we'll just have to wait and see how that phase 3 trial pans out, and then eventually when they do get to market.
And Anj, what exactly are investors looking for from Amgen? I mean, we know like GLP-1s are the hot thing. Weight loss drugs are such an area of interest for investors. And so you would think there would be all this enthusiasm here. But what specifically do they expect and do they want from Amgen to try to meet some of those other competitors?
Yeah, so the tolerability was one part of it, but they've also kind of just been sort of mixed bag on the stock itself, wondering where Amgen gets to play. It's important to remember that this is a differentiated drug because it is going to be a once a month injectable rather than the current weekly. And so that really reduces the burden on patients. And it's a reason why a Jefferies analyst was saying earlier that it looks like really this could be the play. Amgen Amgen remains debated by investors, right? But they still get pretty good feedback from the doctors, and that's the part that they have to look at, is that what are the doctors going to be prescribing? Because at the end of the day, that's where the pickup is for the medication. And so if doctors like it, then they're going to be really more likely to prescribe it. And in addition to that, Amgen is also studying the drug for quarterly maintenance. They've noted that the drug has sort of a lack of plateauing at the end of the current study, and they're going to look and see whether or not more weight loss is possible. So it could still end up being competitive, is what they think. So there's a lot to really wait and see on this drug right now.
All right, thank you, Anj. Appreciate it. Coming up, it is the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into 2 stocks to help you make the best moves for your portfolio. Stay tuned, much more market domination. That's still to come. What's a big, noisy universe of stocks out there? Welcome to Goodbye or Goodbye. Our goal here to help cut through that noise to navigate the best moves for your portfolio. Today we're dissecting valuations, and I'm here with Tom Hayes, Great Hill Capital Chairman and Managing Member. You're bullish on Albemarle, Tom, so that's where we're going to start. We're going to go through the reasons why you like this name, which, by the way, it hasn't had kind of rough, year to date. It's been kind of rough, but we're going to walk through why you say this one's a buy. So let's go through the points. First point, huge operating leverage.
Yeah, this is a big deal. So they're a lithium producer. They're the lowest cost. They're one of the largest lithium producers. So right now, lithium prices go in 5 to 8 year cycles. We're at the trough of the cycle. It kind of fell into the EV narrative that people don't want EVs anymore, but that's really not the story here. As the price turns, as it does every 5 to 8 years, even pre-EVs, we're talking 40 years, this has been going every 5 to 8 years, the cycle. The amount of operating leverage that Albemarle has to benefit as prices go up is astounding. And in the short term, they've got ample liquidity to ride through that trough while their competitors will fall away at the wayside.
All right, second reason, you say this one's a buy, demand growth.
Yeah, so the EV story is predominantly a China story. China has 60% of the EV market. They're growing in leaps and bounds. This is an unnatural, subsidized market that's going to continue. It's an initiative of the government. US, by contrast, only has 10% of the EV market. But that's not the source of the actual growth for lithium. It is energy storage systems, okay? That's expected to have demand from 1.2 million metric tons to 3.2 million metric tons by 2030. Albemarle is going to be the key beneficiary of that growth.
Final reason, you say to pile into this one, dividend aristocrat.
Yeah, they've been raising the dividend every single year for 30 years plus. That makes them a dividend aristocrat. Stable balance sheet, $3.1 billion of liquidity. The market is expected to rebalance by 2026. And when they rebalance, it's the stock is down materially. We do turnarounds. My nickname is Turnaround Tom. So this is a 3 to 5 year play. This stock from current levels, it's trading around $55, $60, could go back up to $150 once the cycle returns and the operating leverage benefits. And you're locking in a yield at current low levels, so you're getting a high yield on the stock. It's below 3%, but not only will you lock in that high yield, but they'll continue to increase the dividend every single year, similar to what Buffett did with Coca-Cola in 1989, and he gets more dividends than his basis every single year, 20, 30 years later.
All right, turn around, Tom, but here's the thing. So viewers are watching this right now. Before they commit capital, what are some downside risks they need to think about here?
Yeah, I think the biggest downside risk would be if the Chinese government did an about-face and they said, we're no longer going to subsidize our green initiative. It's a very low probability, but some of that demand is from the unnatural subsidies in that government initiative. That's going to continue, and we think it's part of their domestic consumption plan for 2030. They want 70% internal domestic consumption. So I don't see that happening, but that would be a risk.
All right, so that's your buy. Let's move to the name you don't like, and I like this one. I like this one because people have very strong feelings about it. Palantir, not a fan. Let's go through these reasons as well. Stocks overvalued.
Yeah, look, it's $324 billion market cap on $3.9 billion of sales, 83 times sales, 200-something times earnings. So you're effectively, look, if you believe in Palantir, and they certainly do have a defensible moat, they're going to do great things. The question is, how much of those great things that they're going to do over the next decade are you already paying for today? Current valuations, you would have to grow revenue at a 50% compound annual growth rate for the next 10 years to justify the current valuation.
All right, bullet point number 2. So it's too rich, the second reason.
Yeah, so 50% of the stock, a little more than that, is owned by retail investors. If that sentiment turns, like we saw with the meme stocks, whether it was AMC, high valuation, not really on the basis of current fundamentals, GameStop, et cetera, when they fall fast. When they exit all at once, so you have some risk there.
And a final point here, the reason you'd say to avoid it, aggressive competition.
Yeah, there's no question. You've got Databricks, you've got Microsoft, you've got AWS, you've got all these companies coming into the arena. I would say another red flag has been the insider selling, $125 million in the last 30 days alone. The chief technology officer is selling like his pants are on fire. I mean, unless the guy wants to buy a $120 million house, I don't know what he needs all that cash for. So it tells me maybe it's gotten a little ahead of itself. The other thing I don't like is that they've diluted their owners and increased the share count by 4x over the last 6 years. So even if they continue to do that, if they keep issuing stocks to management in abundant amounts, what is your slice of the pie going to look like if you buy today and they 4x the share count again over the next 5 to 6 years?
Now, before turnaround, Tom, I let you go.
Yeah.
The last thing I need to know, though, where could you be wrong? What are some upside risks I need to think about?
I think the biggest risk, they certainly have a quality product. It's a defensible product. They have a moat around their product. The biggest risk would be is if the Defense Department decided to double government spending on defense, which, given the budget talks, given the initiative of this administration, is probably a lower probability, but not a non-existent probability with everything we've seen over the weekend. Nothing is out of the question, in which case Palantir would be a beneficiary. Government spending would go up. Their contracts would probably go up.
And we should know the stock has been a monster, Tom.
Yeah.
It's up about 85% this year already. It was up around, last I checked, 480% over the past 12 months. What a run. But there it is. Portfolio recommendations: buy Albemarle, avoid Palantir. Thank you so much, Tom. Thank you for the viewers as well for watching Goodbye or Goodbye. More market domination right on their side. Over the weekend, Iran's parliament reportedly pushed the nation to close the Strait of Hormuz. And while there has yet to be a major disruption to the global oil supply, any sort of closing of that waterway could spike prices around the world. About 20% of global oil and gas flows through that narrow passageway connecting the Persian Gulf to the rest of the globe. According to the U.S. Energy Information Administration, about 20 million barrels of oil, about 1/5 of daily global production, flow through the strait every day. Analysts at J.P. Morgan Chase have called a blockage there a worst-case scenario and suggested the result could be global oil prices reaching $120 a barrel, pushing inflation in the U.S. to 5%. Eurasia Group founder and president Ian Bremmer joined our opening bid this morning to discuss the impact, but says there may not be a serious threat from military attacks.
It's one of the most important transit points, bottlenecks for global energy and a lot of other shipping, chemicals, manufacturing, trade, and the rest. There are already a number of oil tankers that have changed their transit plans away from the straits just in the last 24 hours, going around the Cape of Good Hope. It's a lot more expensive. It takes a lot more time, but there's not a belief that it's going to be disrupted by military attacks.
The energy issue is clearly top of mind for President Trump, who offered 2 oil-focused posts on Monday morning. One to the Department of Energy saying, drill, baby, drill, and another told oil companies to keep prices down, as he will be watching. For more on what's next and the key policy decisions at hand, let's welcome in here Will Todman, CSIS, Chief of Staff, Geopolitics and Foreign Policy Department, and Senior Fellow of the Middle East Program. Will, it is good to see you. So this weekend, of course, Will, the U.S. strikes Iranian nuclear facilities. Today, Iran strikes back. They fire missiles at a U.S. base in Qatar. What's interesting, Will, is how the markets seem to be taking this all in stride, with the Dow up about 300 points right now. I'm curious what you make of that, whether the market should be taking this all in stride, Will.
There have been several signs that actually we might be heading towards de-escalation. That might seem counterintuitive because Iran has just conducted a historic first by firing missiles at the Al Udeid base in Qatar. For the first time, we saw images of missiles flying over the Doha skyline. But actually, they seem to have given advance warning. And so I don't think these strikes were necessarily intended to result in a lot of casualties. So this is following a playbook that Iran first did in 2020 after the Trump administration then ordered the assassination of Qasem Soleimani, a senior Iranian general. And they did the same. They fired missiles, but they gave advance warning, which meant that they did not actually result in any U.S. deaths. So for Iran,
I'm sorry, go ahead, Will. Go ahead.
No, I was just saying that this is an opportunity for Iran to show that it has responded to its domestic audience, but ultimately, really without escalating. They have not taken any of the more serious options they could have taken, like closing the Strait of Hormuz, as you were just discussing.
And to your point, Will, I was just going to add that the New York Times, citing 3 Iranian officials familiar with the plans, did say Iran gave advance notice the attacks were coming as a way to minimize casualties. I guess my question, Will, is what do you think now happens next?
So this could follow the same playbook from 2020. The US could choose not to really respond and not to retaliate. And then we enter into a period of renewed negotiations, or at least a winding down of this conflict. But there are several wildcards here. The first is that Israel is now a critical actor in this, and it may decide that it has not yet achieved its aims. and that it wants to keep going with the strikes that it's conducting on Iran. And that might force Iran's hand and make it feel like it has to continue to escalate. The other difference is that this happened in Qatar. Qatar is a country that is has the best relations with Iran of any Arab Gulf state. And I think Qatari officials are furious that this has happened. This undermines their image as a stable island in a troubled region. And so although I wouldn't expect them to respond very strongly or with military action, I think we don't know exactly how the Qataris will take this. But the hope is certainly there that this could be the start of a de-escalatory cycle that leads to a winding down of this conflict.
Will, how successful were those American strikes over the weekend of these nuclear facilities? I mean, did we destroy those facilities and that enriched uranium? What's our line of sight there?
It's extremely difficult to know without having ground access to these sites. The Fordow enrichment facility is deep under a mountain, and there's only so much that we can see from satellite imagery. So without having international inspectors on the ground there to report back their findings, it's going to be really difficult for us to find out. And actually, Iran has already taken steps to end their cooperation with the IAEA, the International Nuclear Watchdog. This is one of the steps they've taken in retaliation. And so it could be some time until we know how decisive these strikes were. But I think what is clear is that all three of the facilities did suffer severe damage and has certainly set back Iran's nuclear program, if not completely destroyed it.
Will, do you believe the regime survives this?
At the moment, I think it looks like it probably does in the short term, at least. I've not seen serious signs of a grassroots uprising against the regime that could topple it. But let's remember that the supreme leader is 86. He is reportedly not in great health. And so a leadership succession was likely to happen in the coming years anyway. And I think then when we do see a new leader, they could decide to take Iran in quite a different direction.
Will, thank you so much for your time today. Great insight. Appreciate it.
Thank you.
And Tom Hayes still here with me. Thoughts on all this, Tom, as we're counting down to the close here?
Yeah, well, first and foremost, every time there's a conflict in the Middle East, everyone's worried about closing the Strait of Hormuz. It's never happened. Not even
Which is remarkable, by the way, that it has never happened. It's never closed.
Markets climb a wall of worry. Yeah. You know, I looked at the most recent Bank of America Global Fund Manager survey, the sophisticated, $500 billion, 222 managers. They are still nearly as pessimistic as they were during the COVID lows, nearly as pessimistic as they were during the great financial crisis. I mean,
those are the pros. What about the retail investors?
Well, look, retail investors, oddly enough, have been right since COVID. They've been buying all the dips when the institutions have been hiding under the table, and they've been making all the money. And I think that trend is going to persist. With sentiment like this, markets don't top when sentiment is that pessimistic. And that's why I think we're going to push to new highs before the end of the summer. Then we'll probably get into some fall normal chop, normal volatility before the end of the year rally. But it's earnings driven. I love they've brought the bar down low for Q2 earnings. 4.9%, easy to step over. You don't even have to jump. Market's going to like that. Global liquidity, M2 money supply, 15 central bank cuts around the world. Fed, by the way, now a little bit of dissension. 3, Bowman, Goolsbee, Waller looking for cuts instead of remaining too restrictive like Powell has been talking about. They probably lay that out in Jackson Hole. So what's not to love? There's a lot of good things. Look, we just went through the end of the world tariff war. We just went through the end of the world, a possible World War III type of situation. And these companies keep chugging along. GDP now estimates.
What worries you? What would be on your list of worries on your radar? Downside risks.
Downside risk would be if President Trump didn't like how quickly the tariff negotiations were going, and he did the hard stop on July 9th, and we're back to where we were in April. The probability is that very, very low. We've got an election coming up in next year. I don't think he's going to do that. He'll threaten it, so you'll have a little bit of volatility on the way up. But on balance, it's continues to be time to be constructive, but selectively constructive. And that is, I think, which Ed Yardeni referenced, is the unmagnificent 493 trading at 18 times. There's a tremendous amount of opportunity and underexposure in those stocks.
Stay selectively constructive. Bottom
That's right.
line. Thank you,
Yeah.
Tom. While we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.